Hello and welcome to the View on the 15th of February. It's Will Riggall here, filling in for Paul Zwee, and I've got John Abernethy with me today. So we're going to run through a little bit of reporting season, what I'm seeing so far, and then we'll get John to update us on his views on some of the big macro data points that have been coming out in moving markets in the last week or so. John, perhaps be happy for me to start off with my reporting season? Absolutely. Well, we're just really warming up. The reporting season peak period is usually the second last and last week of the month of February, but we're starting to see some big companies start reporting. And look, we do need a positive reporting season. Markets have been solid, and I think that's kind of what we're getting. So if I just run through quickly some of the key holdings in the portfolio. We had CBA report yesterday. It was actually a better than expected result. CBA has been, as have all the banks, have been performing very strongly. Really what we saw was they've been pulling out of the market, defending their net interest margins, and that's delivering some pretty good results. So dividend came in slightly ahead for CBA. So far, so good. We saw CSL. CSL was down a little bit on the day post-result. What we're looking for was that core business around IVIG and plasma, seeing that growth come back post-COVID. And pleasantly, that's what we're seeing. But their vital business is somewhat disappointing and missing targets. Look, the core business continues to generate strong returns, and we think 10% plus growth outlook for the business more than warrants its position in the portfolio. Touching on a few Goodman Groups out this morning, great result, as we had hoped. They usually put out a guidance that they can beat, and they've certainly done that. The company has been on a bit of a tear of late, and we think there's more to come. And just on the smaller end, Nick Scali, with a few retailers that we really like, good quality companies that just continue to deliver over and over again on their core principles, knowing what they can do, continue to invest in their business. Nick Scali delivered a better than expected result. And as well, look, it's worth referencing some of the smaller companies too. So our small companies fund continues to deliver strong returns above the index, and names that we've talked about before, Setai in the retail space, a small or not so small anymore. It continues to go up and up and up. And then Audinate, another great company in the small companies portfolio, continues to deliver. So far, so good for our small cap names.
Great.
Well, just that is a quick run through, John, but perhaps I could throw to you. Look, we're kind of at the point where we need data continue to be incrementally positive. What we've had in the last week is some comments from Powell, head of the US Fed, but also the most recent CPI print caused a bit of uncertainty in the market, seeing the fall. So perhaps we could get your view on what you're seeing in the CPI. Let's get under the hood and understand what really is driving the markets here.
Yeah, well, look, I think there's a want by asset managers to invest in the equity market, because the alternative, the yield market, particularly the bond market, the yields aren't sufficient. I mean, so you're talking before this little bounce back in or increased yields in the bond market, where 10-year bonds sitting at 4%, highly good enough when inflation's 3 to 3.5. Meanwhile, the cash rate in America, 5.5, in Australia, 4.3 or something. I mean, those cash rates are attractive in America, not so attractive in Australia against recorded inflation. Now, what we saw this week was inflation coming in for January at 0.3, hardly anything to worry about. But when you want to buy equities and you want to keep the bond market under control, there was a lashback, so to speak, in markets because it came in 0.1 higher. The fact is that the 6-month CPI in America annualized is running around 3.2%. Obviously, the monthly rate times 12, 3.6, but you would never take a monthly rate and multiply it by 12. You take the 6-month run rate. So inflation is anchored in America between 3 and 3.25%. Cash rates are 2.25% above that. So very high real rates on any analysis. What we've got to is, will interest rates come down quick enough? And I think when you get these little bumps where inflation on a month is 0.1 higher than expected, it just gives the Federal Reserve a reason to say, nah, interest rates, we can wait another couple of months. And that's what happened. Bond market reacted quite significantly, really. It went to about 4.3% yield. It's now rallying again because everyone realised it was a knee-jerk equities, knee-jerk bonds. But frankly, the outlook is not much for the next 3 to 6 months. Things have rallied strongly. Equity markets rally strongly, and you've got to look to alternative assets really in the American market, and not so much the Australian market. I'd say I still think equities have got value in them because the cash rates are so low and our bond yields are so low, so that drives equities. But some of the assets which have underperformed well in the last year or so, i.e. property, I think it comes back into play, and your comments about Goodman Group are interesting. And I think that's going to go right across the property sector in the next 12 months. So we've gone through a bad period, and after every bad period is a recovery. So property's on recovery. And then the small company part of the index, which was hammered last year. And I know some of our clients were wondering, why we were exposed there, but the last 3 months of 25% recovery is significant. We've got significant bounce back. Question, is that going to continue? Of all the parts of the equity market, it's the smaller end of the market, which probably has got the best outlook for at least the next 6 months, not only through being oversold and very low PEs, but because, merger and acquisitions is going to occur. I think the market's ripe for a lot of rationalisation in the smaller end of the market, stocks which are being left behind. So that's going to propel it. So watch out for all the rumours, watch out for all the plays, and watch out for the recovery there. So I think the small company market will go 2 to 1 again. So it'll be 2 to 1. Whatever the equity market, the broader equity market goes to smaller cap market. And we have that solution with our small company fund if clients want to talk to their advisor about that.
Yeah, no, you're right, John. I think that's where we're at. One thing is the performance between the two, to how much the ASX 100 has outperformed the small ords. But in an environment where you're seeing inflation easing, right? So it's directionally, interest rates are coming down, but we're seeing global growth solid enough and earnings per share in the markets starting to bounce off their lows. We're starting to see improving EPS outlook, and that is usually an environment that is positive for the smaller end. So look, pleasing, we've done a work on our small cap fund, improving the process and getting the right stocks in there, and what will certainly, the most recent monthly will show that things are starting to improve, and we're picking the right stocks, which is great to see, which is the fun part of investing, of course.
Yeah, well, I think it's quite dramatic in terms of the recovery in small cap prices, and also the revaluation of quality small caps. I think what we're trying to do in that small cap portfolio is take it away from speculation into quality companies which generate profit, generate cash, can self-fund growth. And if they don't get re-rated in the market, they will become takeover targets. It's as simple as that. So, and that's the cycle we're in.
Yeah, and we are seeing across the board, it's not just the industrial ones that are relatively cheap. It's these niche providers that really provide a solution. So we're looking for domestic companies that can be global leaders that are being run in ways that you'd normally see in a larger company. So, yeah, high-quality stocks, just not at the valuations with outsized growth. Yeah, it's a great time. John, perhaps I'll switch from a small cap discussion back towards the macro environment. And so I was on Ausbiz yesterday, chatting in the late afternoon close, and a question I got asked was an interesting one. Given the vagaries and what we've been seeing in CPI, the question was simply, who's going to cut first, the US or Australia?
Well, I don't think there's a doubt that America will have to cut first before the Australian Central Bank cuts, thereby following. Australian interest rates, cash rates never went up high enough. They were well below inflation. And right as we sit, they're matching inflation readings. They're not below inflation. America, as we said earlier in the interview, is about 2% below inflation in terms of their cash rate. So America has to cut first before Australia follows. We're seeing it play out in the currency. The differential between cash rates against inflation that's why the Australian dollar can't get itself above 65. It looked like it was going to do it a few months ago when it looked like the American Federal Reserve would cut fairly aggressively, or that's what the market said, so the Aussie dollar reacted. Now what's happening is reality is setting in, and look, there's probably a couple of cuts in America in the next 6 months, but it could be more back-ended than front-ended. So the status quo sits there. US real interest rates well above Australia. US dollar, maintains its premium rating. So that's what we're stuck with. More significant, though, is the inflation outlook. And whilst we got that inflation number from America, which we talked about, there's interesting numbers coming out of China, which could put a real spanner in the works. Now, China is running through a deflation cycle. And I don't know if our clients can remember when we talked about why was inflation so low pre-COVID for that period ex-GFC, is because China exported deflation to the world. took over the world's manufacturing base. It did it better, did it cheaper, and it drove down inflation across the Western world. Then we had a bit of inflation surge, COVID, Ukraine. Now we're coming out again, and China is going to add to that deflation cycle for the world again. So it has to be watched. There is a lot of commentary coming out, which I'm reading, in terms of America now is importing more from Mexico than it is from China. And that's happened in the last 12 months. But prior to that, China was its biggest supplier in imports. So the deflation effect of China is less effective on the American economy, maybe, looking forward, but significant for Australia. And the other call, which I've been reading, and I've still got to develop a view on it, the risk that China does a devaluation because they control their currency. Now, why would they do a devaluation? To make their exports more competitive, even though they're in deflation, make their exports more competitive. That helps local manufacturing, that helps their economic growth, gets them back on their growth cycle. So there's a real likelihood that there may be a devaluation. Again, that's deflationary or inflation down for Australia. I'm talking across this because I say there are significant tailwinds for interest rates to come down in the next 6 months. It's only because Australia didn't rise fast enough that we're not cutting. America has to see, I think America is probably inside 2 or 3 months from a small cut to get that cycle. Last night we saw UK. I think their inflation numbers were very good, but they're in recession. So they've got a bigger problem than anyone else. There is no way interest rates are going up around the world now. We've peaked, they're coming down. America first, then everyone follows.
Yeah, that's really interesting insights, John. So perhaps we're coming up on time. We'll probably leave it there. Perhaps I might pop in a couple of weeks once this reporting season's done and give you our final insights. And it'd be great to see how things play out as well on the macro side. So thank you, John. Always great to see you and always great to chat.
Thanks. Bye.